Good morning, everybody. Happy Sunday. Welcome to Coffee and Conversation. Let's break down ARMs versus balloons versus fixed payments, okay? And I want to do this because I am starting to see the adjustable rate mortgage pre-approvals slowing down, but balloon pre-approvals picking up. And I think it's very important that people really understand the difference in all of these, okay? What's different in an ARM versus a balloon versus a 30-year fixed rate? And why I think it's important is because you need to be prepared to do something when you take out a short-term loan, okay? Temporary financing, short-term loan, adjustable rate mortgage. Why is that? Well, because your loan is only locked in that term of the ARM, adjustable rate mortgage. After that term is up, your rate adjusts exactly as the words stand there. So let's say you have a 5-year ARM. Your rate is fixed for 5 years and then it adjusts according to the market at that time. Typical ARMs will adjust 2%, okay? Some will adjust 3% and some will even adjust up to 5% in that first year. Very critical you understand what term yours is. So that way, if you are in a 5-year ARM, in 5 years, what does that look like for you, okay? Now, starting to see ARM pre-approvals go down and I'm starting to see balloon pre-approvals go up. My take on that is, well, I don't work at any of these credit unions and I don't know for sure, I will preface that, it's not hard to also figure out the layman's terms underneath it. Balloons are a shorter term game. And what do I mean by that? Well, your adjustable rate mortgage still adjusts, right? You can still be in that mortgage and the rate just adjusts. Balloons come due. So it's really, really important that you know what a balloon does. Let's say you have a 5-year balloon. Your rate is fixed for 5 years, and at the end of that 5 years, it does not adjust in rate. Your loan is called due. Even if it's amortized over 360 months or 30 years, it is due. You have two options at that point. Refinance to whatever rates are at that market or sell your house. Or I guess there are 3, just pay the loan off. If you have every ounce of being that you're going to pay that loan off in 5 years, great, no problem. If you don't have any plans of paying that loan off in 5 years and you're not sure you're going to want to move, I would sincerely look at a fixed rate option versus a balloon. Okay, so remember, balloon comes due at the end of the term. ARMs, adjustable rate mortgage, adjust the rate at the end of the term. So if we're looking at a 5-year ARM or a 5-year balloon, the ARM adjusts at 5 years to market price, and then the balloon comes due at 5 years. Now, 30-year fixed, let's just put them up against a 30-year fixed. 30-year fixed, same principal and interest payment, same interest rate, 30 years. Okay, now, why do credit unions or local banks tend to go towards an ARM or a balloon more often than a 30-year fixed? Well, the answer is simple. Most lenders, including Guaranteed Rate or anyone out there, can't just hold all loans for 30 years. They have lines of credit that we put the loans on, we service them, and eventually sell them off to different servicers or again, call them due. So when a credit union or a local bank calls your loan due at the end of 5 years on a balloon, they now free up that money to write another loan. That's essentially what it's for. Okay, that's real layman's terms. There's all kinds of other stuff that goes into it, but I don't want to bore you with the details. So as you know, if you've ever been a mortgage holder, it's typical for loans to change servicing throughout that 30 years. Unless you're a new homeowner who is brand new and doesn't understand that, it's really important that you share this video or watch this to understand what your ARM or balloon could entail. Now, in the next year or so, if rates come down, that would be a great time to get out of your ARM or balloon and get them back onto a 30-year fix. My team and I are very prepared for that. We've already been having the discussion with people that we've closed on. But again, no one has that crystal ball. Are we hopeful that once the inflation heeds and starts to cool more and more, that the Federal Reserve brings those rates back down? Yes. Would we love to see it? Of course we would. However, again, there's all kinds of different things that could potentially happen between there. So we just need to be prepared for the long game. When you own a home, it's typically the long game, not the short game, unless you're a flipper investor. This video is probably not for you then. I'm talking to people who are going to live in their houses. 5 years comes fast. 7 years comes fast. Heck, 10 years comes faster than you think. So make sure if you have an arm or a balloon, you understand and that you're prepared. If you don't understand and that's exactly what your loan is, call my team and I. Not saying I want to refinance you right now, but I'd love to get you into education so that you understand where you're at and the timeline so that if the market drops, when the market drops, you are ready to do something to protect yourself. Far too often, I've talked to clients who have either just closed on arms or balloons or have a pre-approval for an arm or balloon and they have no clue what that means. They're only attracted in being sold on that bright, shiny rate because it's typically lower. However, sometimes lower rates can cost you a lot more in the long game. So be careful. It's not just about a monetary monthly savings. It's about the long-term game again. And is that going to be good for you? Or are you going to have to pay a high amount of refinance fees to do something later on? Are you going to have to refinance, take a higher rate later on if you don't do something prior to? Those are the reasons why I felt it was so important to come to you today. So just keep an open mind on it. Drop your comments below. My contact information is here. Give me a call, shoot me an email. Let's have a conversation so you're prepared on how to best protect your home and your home loan.